Most investors don't fail because of the market. They fail because of emotion. They do not fail because they lack access to brilliant analytical tools or up-to-the-minute information. Instead, the vast majority of investors fail because of their own feelings. Fear, greed. These ancient impulses are a terrible guide for navigating the modern financial landscape. Learning to recognize and control these internal reactions is the single most important battle an investor will ever fight and win. The market is a relentless engine of volatility. Prices move up, prices move down, every single day, every single hour. Those fluctuations create a narrative of uncertainty and anxiety. The few who win quietly ignore those internal screams. Successful investing isn't about a secret formula. It's about building a psychological fortress around your financial plan. The real adversary in investing is not the market. It's the reflection in the mirror. Panic selling is perhaps the most common and destructive behavior an investor can engage in. Imagine watching a stock you own, or the entire market, plummet by 20 or 30% in a matter of weeks. The numbers on the screen turn a visceral, alarming red. Your mind isn't calmly assessing businesses. It is flooded with fear. The instinct to stop the bleeding, to make the pain go away, becomes overwhelming. This powerful emotional response drives you to sell, converting paper losses into permanent losses just to find relief. But this feeling of safety is a dangerous illusion. Markets have a long history of recovering. Missing just a handful of the best performing days can devastate long-term returns. The calm from selling is temporary. The regret is often permanent. Smart investors do the opposite. They buy fear and ignore noise. They see downturns as opportunity, not threat. Chasing hype is the flip side of the panic-selling coin, driven by greed and the fear of missing out. Stories of astronomical gains spread. It seems as though everyone you know is getting rich from one amazing opportunity. By the time it's a sensation, the biggest gains are gone. Latecomers often buy near the peak, providing exit liquidity for early investors. Consider the dot-com bubble, certain cryptocurrencies, or meme stocks. Narratives promised to change the world. Valuations were ignored. When the bubble bursts, speculative wealth vanishes and late buyers are left holding the bag. The antidote is skepticism and a steadfast commitment to your plan. Boring can be beautiful. This leads to the destructive habit of overtrading, constant buying and selling to time short-term moves. Every trade incurs costs. Commissions, spreads, and taxes accelerate withdrawals and reduce compounding. Small frictions add up. Overtrading raises the odds of poorly timed decisions, selling just before positive news or buying as a downturn begins. Each decision point invites fear, greed, and overconfidence to override judgment. Studies consistently show the more an individual investor trades, the worse their performance tends to be. Smart investors do the opposite. They stay invested. They reduce trading frequency, minimizing costs, deferring taxes, and removing opportunities for emotional error. No one knows the next crash or rally. Prediction is ego. Process is power. Smart investors recognize the futility of prediction and instead put their faith in a process. A process is a set of predefined rules that remove emotion and guesswork. One powerful process is dollar-cost averaging. Invest a fixed amount at regular intervals regardless of market moves. For example, $500 on the first day of every month. When prices are high, you buy fewer shares. When prices fall, you buy more, lowering average cost over time. It removes the paralyzing question of, is now a good time to invest? Your success becomes a function of your discipline and your savings rate, not soothsaying. Another essential process is rebalancing, returning your portfolio to its target mix. After strong stock runs, risk drifts higher than intended. Rebalance by selling a portion of winners and buying the underweight asset. It feels counterintuitive, and that's the point. It enforces buy low, sell high, and keeps risk in line. Over full cycles, rebalancing smooths the ride and aligns behavior with long-term goals. Smart investors. Dollar cost average. Rebalance. Stay invested. Wealth isn't built in months. It's built across decades. The market rewards patience more than intelligence. Starting earlier grants a massive advantage because time does the heavy lifting. Think of investing like planting a forest, not a vegetable garden. Plant well, water, give sun, then trust the process through storms. Daily news is just weather. Focus on the long-term climate. Stay invested and let time work. The journey is internal. The only variable you control is your behavior. You are not playing against the market. You are playing against your own instincts. Avoid panic selling. Ignore hype. Stop overtrading. Replace prediction with process. Dollar cost average. Rebalance. Think in decades. Be patient. Be disciplined. Let time and a good plan be your closest allies. If you can control your behavior, your money will eventually take care of itself.